Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino. Joining me for this segment, we have Jim Cassel, co-founder and chairman of Cassel Salpeter Company. We're here to discuss how macroeconomic trends are impacting deal making, investor appetite, and corporate valuations. Jim, it is great to have you with us. Welcome to Trade Talks. And really, that's what the conversation has been centered around when you think about the deal environment and the impact that the macro is having. There were so many expectations coming into this year, and it's been relatively quiet for the first quarter.
Wow, and thank you, Jill. Thank you for having me today. It's been an amazing quarter because if we talked in December right after the elections, everybody was thinking this is going to be the year. They said that a year ago, but now they said people thought again, and it just hasn't panned out in the first quarter. And there's a lot of reasons that I think that it hasn't panned out. The general uncertainty that's going on out there, the instability, the inconsistency, are just getting people nervous. So it's sort of we want to do something, but we want to wait and do the right thing,
Right.
not necessarily from the seller side, but from the buyer side.
Yeah, because fundamentally, the M&A market, it is quite strong. There are some, great use cases for what's happening within that environment. So it seems to be it's more of the macro than the actual underlying fundamentals.
Right now, the fundamentals seem to be good. We'll see how the numbers come in for the first quarters for the bigger companies, but we're dealing with more the private companies. And the biggest concern, of course, is tariffs. And if we understood what they were, then you could negotiate around it, you could deal with it, but it's still uncertain and it changes. So that's resulting in people going a little slower and really trying to understand who should bear the risk. If it's 100% cash, it's one thing, but if there's going to be some kind of earnout, there's a real concern on the sellers as to they're going to be potentially out of control and not have control over earning their earnout.
Yeah. So, Jim, when you're thinking about, how businesses should be navigating this type of environment, perhaps tariffs is something that we could be facing for the next at least 3.5 years, where it could be an ongoing negotiating tactic. So, when you think about businesses navigating this environment, whether it's related to the tariffs, inflation, broader economic data that businesses are relying on, what are your thoughts around that?
One of the purposes of the tariffs is to bring more onshoring, and industries have been doing that where they can. But the auto industry is obviously fairly interesting, and we look at not the big companies, but the suppliers and people of that nature, and they're trying to bring more of that onshore. They thought they had that with Mexico and Canada. Now they need to bring it even, shrink it in further. But keep in mind, when you decide to manufacture, in most cases, many products in the U.S., it takes time, it takes capital. You can't just wake up today and say, I'm going to build that widget here in, call it West Virginia, great place, good labor, what have you. It takes time. Now, it may take less time because some of the environmental things that are going on are making it easier, less constraints, less government regulation. But you can't build something in a matter of hours or days. It takes years. First, the planning, then the building, then the training, and then maybe taking your molds that the company owns its molds in China, owns its molds in Vietnam or Mexico, and trying to bring them in. It takes time to do that. And companies are looking at that and trying to figure out how that's going to affect the bottom line.
Yeah. Well, I mean, to your point, onshoring was a trend well before the new administration came in. And then, of course, having the right labor and the skill set to be able to execute on these plans and designs, it's from the bottom up in terms of the supply chain.
And labor is an issue. Right now, robots are somewhat helping. Robotic companies are trying to help fulfill some of those needs. But, we are at historically low unemployment, trying to get people for all of these factories. It's wonderful to build all these factories in Arizona, but if you don't have the labor pool, and it's not a function of just getting people to move there, you got to have housing for them, you got to have infrastructure for them, you got to have schools for them. If they're working full time, you got to have daycare for them. There's just so many different things. It's the unintended consequence, or maybe not a consequence, but the issue of really planning. You need to do it all. You can't just drop it in and everything's wonderful.
Yeah, I mean, anecdotally, we saw that when with the mass migration to areas such as Florida or Texas, the Austin area, as an example, where the infrastructure just couldn't keep up with the influx of people, whether it was related to onshoring or not. It was just a big trend, that demographic shift. But we saw that strain on the infrastructure and, having these services available. To your point, are there certain sectors or areas that are perhaps more immune or more insulated from what's happening in the macro?
I don't know. It's funny. You would think potentially the biotech industry, but when you think about that, moving factories into the US as opposed to India or China. But even if they're manufacturing right now in the US, they're buying many of their chemicals from China that are in it or going to Mexico. So that's one industry. Auto industry, people thought, like, as I mentioned earlier, were covered, with things. So, but Mexico, tariffs, those cars go back and forth, even, cars that are made in the US, they go back and forth across the borders many times. So people are trying to figure out how to bring more of that in. Now, maybe you have some factories you can move, if it's someone like a General Motors can move stuff from Canada to the US, but then you've got union issues. And again,
Right.
so many other issues that have to be dealt with. It's not, you close on Friday, you open up on Monday, and things are wonderful. It doesn't work quite like that. You need lead time. And you also need to understand the stability. If we just knew this is the way it's going to be for the next 3 years, we can plan for it. But we're not really seeing that. So when it goes to the M&A issue and when we're selling businesses, it's trying to understand, and it's almost gamifying. What if this happens? What if that happens? So a buyer says, well, I don't want to pay a premium price, because if I pay a premium price and that happens, now I've overpaid, or I've loaded it up with too much debt, or I can't make my debt. And then the other thing with tariffs we're seeing is, if things come in with tariffs, 20%, 30%, whatever they are, how much can you get the supplier to absorb? How much will the company absorb? And then what are you going to do in terms of raising prices? And will, your end customer, if it's a consumer product, will the consumer pay more? Will they start going downstream to a lesser quality product, a lesser price product? So a lot of issues that we're dealing with you can't imagine, all kinds of businesses right now.
Yeah. Well, I mean, it's a great point that you bring up as well. I mean, the consumer, if you just look at, even though inflation, as example, might be flat year over year, we're still thinking about what pre-pandemic prices were like. And I don't think the consumer, it would be a big, comms issue in heavy lift just to be able to rationalize extending more for the consumer. Let's say in a perfect world, April 2nd, whatever date you want to set, that we do get clarity. There is structure around tariffs. They understand how margins are going to be impacted. They understand what the impact is going to be to the consumer. How does the pipeline look? Is it ready to go?
There are a lot of people who are ready to sell right now. Some of that is actually being driven. We have one we're working on right now by the uncertainty that they want to get something done sooner rather than later. We haven't really talked about the tax effects on these things, whether the tax rates are going to change, go up, go down. Um, that may affect people, but there is some benefit to having cash, and if you're going to sell them, you might as well sell now. So there's pent-up demand to sell. Of course, the buyers out there, the strategics, have had a few good years, coming out of COVID. The private equity firms maybe didn't raise as much money last year, but they still got plenty of money, dry powder.
Yeah.
The lending sources, the banks have money, but alternative lenders now have plenty of money out there. Now, maybe it cost a couple of 100 basis points more to finance with one of the funds. And the default rates are low, so they're willing on a risk-adjusted basis to lend at good rates. So there's opportunity, there's money there to buy, there's products there, just want to price it right.
All right. Well, we certainly look forward to having you back once we get some more clarity in the environment, Jim. Appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you so much. Have a great day.